Now here the financial institutions, as I have told you that just like banks, any big business houses which are providing financial services to the customers can be called as a financial institutions. Best example, as I have told you, banks, insurance companies, provident fund houses, and any of the business houses or establishments which deal with the financial transactions can be called as financial institutions. Now, what is this financial institution? Act as a mediator between the investor and the borrower. So, this will be an intermediary or a mediator between the borrower and the investor. So, who is that borrower here? The borrower of the loans. So, when you talk about any bank, what this bank will do? So, bank will start its branch, and the main purpose of doing the business of a bank is borrow for the purpose of lending. So, accept the deposits for the purpose of lending. Now, people who save the money, who have savings with them out of their income, they will save with the banks. Now, that is called as the investors in the bank, or the people who have saved the money with the bank, or the people who have deposits their money with the bank. Now, that money the bank will use it to give it as a loans to the borrowers. So, borrowers, what they do is the any business houses, or maybe even people in many cases, they require personal loans, they require housing loans, or they require some other student loan, education loan, different types of the loans they require. Now, these loans, how the banks can provide? Banks will not give the money out of their pocket. Banks will provide the loans from the deposits which they get from the depositors. That money the bank will provide it as a loans to the users of the loan or the borrowers of the loan. So, here, so this financial institutions will act as a mediators, or they will be in between these two people, the borrowers as well as the users. So, the investor savings are mobilized either directly or indirectly via the financial markets. Now, the investors savings means, as I have told you, that many people are there in the country. So, they have saved their money, and those money what they do is where they save with the banks or any financial institutions like insurance company. And they save that directly or indirectly means here they save the money by opening an account directly. So, their money will be directly with the bank, and then indirectly means they may buy some mutual fund units. So, mutual fund units, when they buy, naturally the mutual fund again it pools the money and it will make an investment in the corporates, in the shares of the company. That is indirect rate, indirect route, directly or indirectly. So, what the people will do is they save the money, and this money will be used for given as loan to the investors, or maybe this money will be used as a capital to various business houses. So, this money will be used as a capital to various business houses. The main function of the financial institutions are as follows. The short-term liability can be converted into a long-term investment. The short-term liability means here the people, they save the money with the bank, and their savings will be for a short term. Now, here they save the money, they say that I have money, I'll go with save with the bank, and whenever on demand the banks will pay the money to me. Now, like that, so many people, they save the money with the bank. Now, all that savings, now the bank, what it will do is it will make a systematic plan. So, these savings, what I can do out of these savings, 30% or 40% I can keep with me, okay, as per the capital adequacy ratio, and then remaining certain percentage of money I have to keep with me as a form of maybe in the cash as per cash reserve ratio, it has to keep some amount of with me. And as per SLR, statutory liquidity ratio, it can keep in the form of either gold or it may be in the form of treasury bills, most liquid assets, and the remaining it will give it as a loans. So, the savings that is made by the people, either a small saving, short-term savings or long-term savings, this money the bank will utilize it for giving as a loans to the customers. So, this is how the banks will use the short-term savings to give the long-term loans to the customers. And these insurance companies also, when you observe, so the premium that is paid by the insurance holder. So, this insurance holder, what he will do is he might take a policy, and that policy will be for 10 years time or 20 years time. So, during that policy duration, the insurance company will take the responsibility providing the losses to the insurance holder. Now, these 10 years time, what the insurance, what is that policy holder will be doing is he will be paying the premium every year. So, the money or that the savings that the insurance company gets, so that they will use it as a to give as a loan to the customers. So, this is very, very important. So much of money will be to the insurance companies, and these companies will not have an obligation to pay it immediately, because very few cases what happens is risk that is will be arises to the customers, very, very few cases. So, otherwise what happens is the savings of all these people will be deposits to that particular insurance company, and this insurance company, they can use this money for productive purpose by giving it as a loan or any other capital to the business houses. So this is very good way of functioning of the financial system, right? So in India, we have a strong financial system. We have a very great institutions like banks or any insurance companies, which are helping these particular businesses to start and grow, right? And this is how we can see that economy is also flourishing. We observe this for a 20 years time period. When you observe for 20 years time period, Indian economy is going very fast comparatively with other countries' economies. This is only because of these financial institutions and markets that we have, or if these financial institutions and markets that we have in the country, well regulated and well established institutions and markets helps for the growth of the economy. It helps in conversion of risky investment into a risk-free investment. So here again, investors, if at all they need to invest in some company shares, what is that they can do? They can invest. As they invest, what happens is investment in shares. I always tell you that it is subjected to fluctuations, and as more fluctuations is there on your investment in any share, naturally the risk of your investment will be very high. You can take another route, indirect route of investment by investing in mutual funds. So mutual funds also a type of investment in shares, but that will through which what happens is as you invest in mutual fund units, the professionalized management who is an expertise in that particular area of investing in stocks, he will be managing your funds. Thereby, what happens is your investment will not be that much risk. Otherwise, you might have invested directly in the stocks. So thereby, what happens is risk will get minimized very less. At the same time, what is that meaning here is conversion of risky investment to risk-free investment is if at all you give the money to any of the outsiders, naturally, what happens is there will be a lot of risk that is there for you. Why? How it will be a risk is the people who take the money from you, they may pay the money or may not pay the money. So thereby, what happens is your entire money, maybe a principal or an interest rate, that will be at loss. You can do other thing is by investing in either mutual fund in units, or you can invest in bank, make a bank fixed deposits, or you can take any policy. So what is that? These all type of investments through which what is happening is your risk on investment will be reduced and will sometimes make it a risk-free investment also. So also acts as a medium of conversion, convenience denomination, which means it can match small deposits with large loans and large deposits, small loans. Now here at the convenience of the depositors, in fact, investor or depositors. Now investors and depositors at his convenience, what he can do is he can invest in the any of the financial assets. For example, he can make a short-term deposits with a bank for a 3 months time, or for a 5 months time, or 6 months time. Now bank has a facility that you can deposit for how many months you require. Maybe 5 months, 5 days, 5 months, 6 days, 5 months, 10 days. So this is how the duration you can fix, and you can deposit with the bank, and bank can utilize the funds accordingly, and at the end of that particular duration it will pay you with interest. And also you can also invest in shares of the company. This is also a financial asset. And when you invest in the shares of a company, what happens is again, if at all you invest, it's not required to hold for a quite long time. As you invest in that company, and if you do not want to hold that particular asset or financial asset of share for a long period of time, you can sell off and you can encash. So this is a facility for you. At your convenience, you can deposit the money for the duration. The money that you deposit is it's up to you. How much you want to invest, you can invest. At the same time, the duration also. So you can invest for 3 months, 5 months, 6 months, or at your convenience, right? So this is how that small deposits will be utilized for long-term loans, or long-term loans can also be utilized for small deposits. It's all that the financial institutions, how it operates. They have a mechanism to operate in such a way that small savings can be converted into long loan. They can manage their performance. They can manage their operations so that small savings will also be used as a long-term loans. Right? They have a managing operations mechanism through which it can do it. The best example of the financial institution is the bank. People with surplus amounts of money make savings in their accounts, and people a dire need of money take loans. The bank acts as an intermediary between the two. Always talking about the bank as a financial intermediary. So financial institution like a bank, so they help the financial system to run very smoothly by acting as an intermediary between the two. Who is that? The savers as well as the users of funds. In the absence of banks, please imagine how the economy will be. There will not be any trust within the people against each other, and there will be a lot of problems that arises because of the financial transactions. Because remember, any problem, any differences between the people that arises because of the financial transactions and because of misdeed. So that will not be there if you do with bank. So bank assures and promise you that the bank will pay you a certain rate of interest. As promised, it will do it, because the bank has been again governed by another institution that is called as regulatory body, RBI. RBI is there to monitor and see the functioning of the bank. If at all something goes wrong, RBI will question the bank and its functioning. And if that bank is not correcting properly on the lines or the guidelines that is given by RBI, the license of that particular bank will get cancelled. This is all considering the interests of the investors and the to build the confidence that particular investors or the depositors they have on the banks. Now, banking institutions or depository institutions. Now, here when you talk about the financial institutions, we have so many number. So, let us talk about the core financial institutions. What we have, one is banking, another one is non-banking. So, banking institutions mean, as I told you, banking is accepting the deposits for the purpose of lending. That is the main duty of the bank. Now, banking institutions, how it works is this includes banks and other credit unions which collect money from the public against interest provided on the deposits made and lend the money to the ones in need. So, here the banks, how it works, they accept the deposits, and on the deposits which is made by the savers, they pay the interest, and the money which it has collected as deposits from the savers, that they will give it as loan to the people, maybe personal loan or maybe housing loan or maybe educational loan or maybe any other loan to the people as well as to the business houses. So, business houses, they open a corporate account with the bank, they take a loan from the bank. So, as per their requirement, banks will also provide loans to them. So, these type of loans will be provided by the banks to the people. So, these are the core functions of the banking system that we have in India. We have non-banking institutions are also there. So, non-banking depository institutions are insurance company, mutual funds, and the brokerage companies fall under this category. They cannot ask for a monetary deposits but sell the financial products to their customers. Non-banking and banking. How do you differentiate? Non-banking is a banking institution, non-banking function, non-banking organizations is a financial institutions which will not accept the deposits for the purpose of lending the loan. Very few are there, it accepts the deposits, but many cases how the non-banking organizations function is they provide some financial services without accepting the deposit. Deposits will not be made or will not be taken from the savers. Okay. So, from the account holders or just like bank, it will not work. They will not accept for lending, but they will lend the money what they have with them. So, that is financial. We have insurance company. Insurance, we all know it. So, insurance companies, that's not banking. In fact, true core banking, insurance business is not core banking. Insurance premium will be paid by the insurance holders. That premium will be utilized by the insurance company to give it as a loan, right? So, insurance premium will not be paid on demand. It's not just like a savings account that is opened by a customer with one of the bank. So, insurance policy is a contract between the insurance company and the one who has taken the insurance on his life or maybe on his health or maybe on the personal asset. So, that is a contract. Now, as per the contract, the insurance company has a responsibility to pay for the losses. If at all, as per the contract, some risk arises to who have taken a policy with the insurance company. Now, the point here, what I am telling is the insurance business is not just like a banking business. It's a type of business that comes under NBFC, non-banking finance companies. So, and then mutual funds, we all know it. Mutual funds is indirect route of investing in stock. So, mutual funds, how they invest in stocks is, so they ask the investors to deposit in the mutual fund units. When a fund get opened, the mutual fund organizations, they encourage the investors to deposit their money in units of that particular mutual fund. When that particular deposits are made in that units or when the investors invest in the units of mutual funds, a fund manager will be appointed to manage that particular corpus of that particular fund, and the fund manager will invest on behalf of the investors in stocks. Usually, the mutual fund manager will be an expertise person in the area of financial portfolio management. So, he better manage the stock, your funds, and thereby what happens is it will grow over the period. Your investment will grow over the period. And other categories, mutual fund brokerage companies are there. Brokerage companies are also there, which provide financial services. So, they help you to buy and sell the stocks, and they provide other brokerage services for you in the market, so thereby you can get your work done, fall under the category, and they cannot ask for a monetary deposits, but they sell financial products to their customers. Now here we can also categorize these financial institutions in the other way. Broadly, we have seen you can categorize basically the financial institutions into two. One is banking and non-banking. We have other financial institutions are also there in the market, which provide some regulatory and specialized services to the customers or to the financial institutions which are there in the market. For example, regulatory means controlling. So, these financial institutions which are there in the market, their operations need to be controlled. As I told you that banks have been started, and the banking business is purely based on the trust the savers or the depositors has on the bank. So, the people has a lot of trust. People, as they have trust with the bank, now what they have is they deposit their money with the bank. And how this trust is maintained? For a quite long time, the trust need to be maintained. It should not get broken. And who will do that? Reserve Bank of India will do that. So that's the reason it regulates the operations of the bank. All the time it sees that, so whether the banks are been performing properly or not, the functioning of the bank, whether it is good or not. So core banking functions, it is performing or not properly. And if at all the banking is not performing, conducting its business properly, now the Reserve Bank of India will step in and will control the business operations of the bank. And RBI is also one of the regulatory body which also monitors the inflation situation in a country. So it will also, through its monetary policy, it will regulate the money flow in the country through its monetary policy. So that is how the RBI plays a very important role in the economy. So that we say it's a regulatory body. So you might be seeing about when inflationary tendency is there, RBI through its monetary policy, it will change the repo rates, the reverse repo rate, and other bank rates of the bank, and thereby what happens is inflation will be again brought under the control. So this is about the RBI. IRDA is Insurance Regulatory Development Authority. This is a regulatory body which regulates the business of insurance companies. So insurance companies are there that's doing great business in a country like India. We have general insurance business, we have life insurance business, and these insurance businesses need to be controlled. So who is that regulatory body to control these insurance businesses? Again, IRDA. We have earlier before we only public sector units which were there into the insurance business. Now, private companies were also invited to participate in this insurance business, and license were given, and their business, how it is being monitored, who is being monitored is the IRDA. Again, it is monitoring the operations of various insurance companies. So when this type of regulatory body is there existing in the market, naturally the business will be conducted very smoothly, and the confidence of the people upon these financial institutions will be intact. Many cases what happens is it will get built also. We have SEBI is there, Securities Exchange Board of India. This is a regulatory body which monitors the capital market. So that is the Indian stock market, IPOs, FPOs, and the secondary market, BSE and NSE, its operations. So it's mutual fund organizations. Whenever they want to float a new scheme, all that permissions who will be given is the SEBI is there. So SEBI is a watchdog of the market. Now, all these functions what we have discussed, these functions will be regulated and it will be monitored by the regulatory body. So, regulatory body, regulator, insurance regulatory is very plays a very key role in the market. Now, intermediaries, commercial banks which provide loans and other financial assistance such as SEBI, BOB, okay, these SBI, sorry. Commercial banks also there, they are intermediaries. First one is regulatory body. Regulatory body will monitor the functioning of the intermediaries. So, intermediaries will maybe the commercial banks which provide loans and other financial assistance like assistance such as SBI, State Bank of India, Punjab National Bank, Bank of Baroda. These are the financial intermediaries. And non-intermediaries are there institutions that provide financial aid to the corporate customers. It includes NABARD, SETB. So here what happens is the non-intermediaries are also there. So these non-intermediaries, they provide financial assistance to corporates corporate customers, and that include NABARD and SIDBI, okay, Development Bank of India, in fact. So, Small Industries Development Bank of India. So, here SIDB, D has to be here, B has to be here. So, SIDB is there, and NABARD is there. NABARD is an institution that has been established in 1982, especially to look for providing of rural agricultural finance to the rural artisans for the upliftment of the rural people in the economy in the country like India. So, NABARD has been started. So, institutions that provide the financial aid to corporate customers, that comes under the non-intermediaries. And this is about in a brief relating to the financial institutions. So, financial institutions are the intermediaries or the institutions which were there in the market, which facilitates the two type of people, that is the people who save the money and the people who use the money. They will be in between these two people, and they help and see that the savings of the people will be smoothly utilized and channeled to the people who are actually users of the money. So, these are the various financial intermediaries what we have and their functions, right?